Let's discuss more with Nitin Bhasin, Head of Institutional Equities at Ambit. Uh, Nitin, hi, morning. You know, equity, especially earnings have been a little better. How do you look at the earnings growth for FY27?
Hi, good morning. Thanks for having me. Yes, you're right. I think the earnings growth, today morning when I checked, 2,000 companies having reported the numbers and roughly closer to about 10% PAT growth. But within that, if you look at the mid cap and the small caps, they're really doing much better as compared to the large caps right now. So when we started the year, we were thinking that we should be closer to about consensus indicates about 15 to 17% earnings growth. But prior 10, 12 months, we'd already seen some earnings downgrades for India. And our view was that we should settle closer to for Nifty 100, closer to about 11% or so earnings growth. This quarter, large caps, top 100 has still held around 10, 11%. So no major reason to, increase my pessimism that there would be more downgrades given that the West Asia war was continuing. I will still maintain that anything between around 12, 13% earnings growth possible. I don't fear material risks to the earnings downgrades here.
Okay. Nitin, hi. This is Harsh here. Give us a sense, therefore, that do you believe that where could the disproportionate or the surprises on the upgrade side come from? If you can give us a sense of that, because that's where the opportunity pocket lies, right?
Really, it's been mid caps and small caps, Harsh. If you look at the top Nifty 50, Nifty 100, it's the number is still about 10, 11% sort of earnings growth. Small cap and mid cap closer to about 20 odd or even higher than that. So I think there been a pocket of surprises over there. Clearly, it lies over there. I think people were worried about banks, that banks could actually see some sort of a stress build up either because of El Nino or because of the West Asia war on the credit risk. I think the numbers and the commentary doesn't indicate that there is a pressure. So clearly, mid caps, small caps holding up earnings surprises, and banks giving a reason for not to be worried about credit risk in India.
Uh, how do you look at some of the sectors, especially from the earnings point of view, and in your opinion, because you said that you looked at 2,000 companies' earnings in the morning. Which are the sectors that standing out with respect to earnings growth, and which are the sectors where we're seeing a pressure coming in?
I think clearly, as you go in, there is an inflationary build-up for the FMCG sector, where the valuations may have corrected. But in the next 1 or 2 quarters, the inflationary pressures for most of the FMCG companies are visible, either because of crude-linked inflation or because of, let's say, food-linked inflation. So clearly, I would say amongst the larger ones, that's one. IT sector, clearly, many of the companies either just barely met or seeing sort of a margin pressure. Many of them are actually perhaps also facing cash flow pressure over there. So I would say these two sectors among the larger names appear to us where the not only the margin pressure is in the hindsight, but I would say in the next 1 or 2 quarters, they would be going through more margin pressures. Beyond that, then the sectors where we believe that there could be a margin expansion, perhaps, why not, you could have some NBFCs because there were worries about that the NBFCs could actually see rate hike pressures. I think if that concern is behind us, the credit growth is looking really good for them, much better coverage of OPEX. So NBFC, wider sector, much larger set of companies, margin support. And I would also add cement. Clearly, cement spreads have actually taken a big beating as we go into the season in the next, festive season, the second half of the financial year. Cement sector could actually witness some sort of recovery in the spreads or margins, EBITDA per ton, as the volume comes back. So those are the few 3, 4 sectors that come to my mind after looking at the numbers.
Nitin, how do you look at some of the non-ferrous metals, Hindalco, Vedanta, aluminium? we've seen, we saw decent numbers coming in from India operations, but since June, there has been some, correction in the aluminum prices as well. Do you see this run up for non-ferrous continuing?
I think our analyst has been indicating that in the case of there could, aluminum, there could be pressure in the pricing, and so hence we don't see a major, upward move in the margin expansion for the aluminum business. Beyond that, not much comments.
Hmm. And how do you also, you spoke about cement briefly, and do you see the capex which has been aggressively planned for by many of the companies now is going on a slow roll now, given the fact that the demand is not as much as there, and pricing is. Is also something which is not stable at many of the regions where the price increase initially in a season is now getting rolled back.
I think the if you look at the cement companies, in the last 10, 15 years, I've not seen that cement companies pull back on their capex materially, because everybody's operating in their regions and they want to maintain their regional market share. And with now top one or two guys consolidating their position in the market, between Adani's and the Birlas and the other guys, I don't foresee a capex growth pullback behind the volume growth in India. On the contrary, I think most of them are expecting that the government, which has been continuously investing anything between 7 to 8% on the gross infra capex in India, that will continue. Perhaps people will invest more money in commercial as well as residential real estate. So I don't see cement companies are pulling back on supply, or giving that guidance that pulling back on supply in order to provide some support to the pricing. So they're all banking on that there could be recovery. So that's my view.
Within the financial services, we saw PSU banks doing decent numbers. There was some margin NIMS compression coming in for some of the private sector banks as well. What is your view between private and public, and are you still in favor of the private sector?
Yes, after last 6, 7 quarters of a very good run for the public sector banks, where perhaps they were sitting on excess liquidity, which helped them gain market share in the credit market. I think we believe that that cycle could be behind us. As a house, we prefer private sector banks to public sector banks. Public sector banks today are not only, I would say, in a weaker position compared to PVBs when it comes about a deposit generation, because the liability franchise, they haven't invested in that much. They were only using their excess liquidity. On the credit growth also, you saw that some of the private sector banks recently actually posted very good numbers. So hence, this reversal of trend in terms of a excess liquidity and perhaps private sector banks going out and finding better opportunities for credit. Remember, this quarter they were able to lend to OMCs, working capital loans, and even SMEs and MSMEs, and now some of them are also approaching gold loans. So I would say private sector banks today over public sector banks.
And within public sector bank, the SBI numbers were very good. Have you and they're talking of a guidance of basically somewhere around 14 to 15% of credit growth for FY27. Given the fact that there's a high base effect which is coming in the second half because of last year. Is that decent growth you expect for the full year?
I think that's a number that we believe that the whole sector should be able to post. I think some of the private sector banks should grow slightly higher than that. If SBI can do 14, 15, some of the private sector banks can do anything between 16 to 18%, even at a larger base like HDFC banks or the ICICI banks, etc. So they should be able to. So I think that's good guidance. But at the same point in time, the chairman also mentioned that it is time for the banks, especially private sector banks, to figure out how the government can allow them recycling of capital through securitization. Perhaps they are concerned about the CASA, the battle for CASA. Remember, the easy CASA is behind us, where mutual funds are getting a lot of money for CASA. NBFCs can do securitization, but banks need to go out and find more avenues for liability origination. So I think that is something to be watched out for. if something changes on that, perhaps that changes the game for large banks versus NBFCs. And within that, some of the even in public sector banks, because they may be sitting on large mortgages. So unless and until something like of that nature changes, I would say private sector banks in the next 12 to 18 months should be doing tad higher than the PSBs.
And payments and payment entities running up on the back of MDR expectation. Do you think the government will allow a marginal for at least from the merchant point of view, may not be customer to customer or from may not be on customers?
Yeah. So, I think a lot of the government regulations around whether it is this particular suggestion, they've been doing rounds in the past also, very similar about changes in the insurance distribution. I'd rather not comment on things which perhaps are speculative, or keep on going back and forth in terms of whether when it will happen. So I'll hold back.
Nitin, just last off, just leave us with sectors where you believe that there's a bit of overvaluation, where things have run up and factored in maybe 2, 3, 4 years of forward earnings, and maybe a little bit aggressively. And if there is a disappointment somewhere, some of these sectors could well slip up. Just give us that color texture.
So, investing many times is a function of the relative opportunities available to you. I personally think that a lot of Indian internet-based businesses, where we carry cells on some of these names, such as Eternals and the Swiggies of the world, or for that matter, even I would say, Urban Company and the likes, we find that the valuations of these companies are stretched, but they are very exciting stories for the new India because they perhaps offer growth versus the other older Indian IT services where there is a very bleak outlook. So perhaps, but that mirage of growth, we've seen that in India, FMCG companies are barely struggling to grow beyond 5%. These Indian IT services companies may be a play off on the new India, but I think valuations over there, their inability to find business models beyond profitable business model beyond food delivery, in the battles of QSR. I find that space to be a little too stressed and ripe for disappointments unless and until consolidation happens over there or their ability to charge customers increases materially from here.
And last off, on IT, what's your view there? I mean, there's just this eternal debate going on, so just have to take your view.
Yeah. So I think IT has become the most discussed in the world. When you travel across the world, people just find Indian IT reason to own is only valuations and somehow they will do something. I think if you look at my analyst view, his view is very clear that we are just struggling between 0%, 1% or 2% sort of a growth. Our worry is the cash flow conversion of the Indian IT services is now coming under question. In the past, it was growth, then it was the deal flow, then it was the margins. Now, if you look at the recent quarter numbers gone by, the cash flows are also becoming a concern. But hey, a lot of that is priced in the valuation also. So we believe fundamentally there will be more downgrades in the years to come, or let's say next 2 or 3 quarters. But the stocks are beaten down, trading at below market valuations in many cases. So hence, who knows that people would actually just consider them as no more place to lose money and just park their money over there. So that can be 2 different views between fundamentals and positioning in the market. Where are we? We will say actually keep it equal weight because yes, it's an oversold. No reason to be overbought, overbuying the sector right now, even if we consider them as defenses, because I'm finding the cash flow conversion defensing capability come under pressure.
Okay. Thank you so much, Nitin, for coming in and giving us that perspective this morning.
Thank you.